Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning. This is Quincy Krosby. It is The Talking Point. It is Monday morning, November 14th. And thank you so much for joining me on the call. Last week was something else. The market rejoiced. The market was exuberant, and it was very clear what it was. It was that we're seeing inflation come down. But I do want to point out that inflation remains high, regardless of the trajectory. The trajectory is that it is down. However, as we've heard over the weekend from Christopher Waller, who happens to be a member of the Fed board, he's a governor of the Fed. He's known as hawkish, but he made it clear. He said, okay, we still have to keep raising rates. Now let's look at it. The CPI report, Consumer Price Index report that did come out, show that in the headline, that includes food and energy, we went from 8.2% year over year to 7.7% year over year. And in the core, which does not include food and energy, we went from 6.6% year over year to 6.3% year over year. That's actually very good news. Now, the question is, does that keep the Fed from raising rates? Obviously, no, the Fed has to continue raising rates until it is convinced that we are getting closer and closer to price stability, which is around 2%. So the Fed still has its job to do. However, one of the results of this report solidified the Fed funds futures market regarding what the Fed is going to do on December 14th. Remember, that's the next Fed meeting. On December 13th, there will be another CPI report. Now, I have to say that if that one shows up that inflation has just shot up for whatever reason, maybe suddenly things change for the December 14th rate decision. But right now, the market is squarely saying that we will go from 75 basis points to 50 basis points as the Fed transitions to a stepping down. That's what they call it, a stepping down. It is not a pivot where the Fed suddenly says, hey, no more rate hikes. No, it is mainly a transition that will allow the Fed to assess, to monitor how the economy is doing without being aggressive with 75 basis points. There's a lagged effect with rate hikes and with rate cuts, by the way. It takes months. Some say it's 12 months. Some actually say 18 months for the Fed to see how the economy, the broader economy, every nook and cranny in the economy is affected by those rate hikes. We all focus on the housing market because mortgage rates come off of the 10-year. And that really worked very quickly to slow down the housing market. But overall, the Fed is also going to be able to see in December the result of the Personal Consumption Expenditures Index. That is the PCE, and it is their favorite barometer of where inflation is going. The expectations there, by the way, are that they're going to see a more meaningful downtrend in inflation when they see that report in early December. I want to say the Fed is still focused on housing and rent because it is a major component of the Consumer Price Index. Rents are coming down, but not fast enough. But every survey, and I'm not talking about, talking to consumers, these are industry-related surveys. Rents are coming down across the country. Now, obviously, the new rents, when you go in and you're looking to rent something, those are coming down faster, obviously, than existing contracts. But normally what happens is if the unemployment situation intensifies in the country, remember it moved up to 3.7%, if it intensifies, typically what happens is if you are running into problems paying your rent, many of the landlords say, okay, we'll lower the rent, we'll make it official. If it takes time. So obviously the surveys we're looking at are about new contracts and they're moving in the right direction. They're coming down. And that will start showing up in the consumer price index report, maybe next month and the month after. That's what the Fed wants to see. So we'll keep our eye on that. Also, last week, let me make this really, really clear. We worried about this perception of inflation on the part of consumers. The Fed and any central bank does not want to see consumers seeing inflation climbing higher because it leads to hoarding and spending more money. And I better buy it today. I bet, going on and basically increasing consumer expenditures. So what we saw was that from the University of Michigan Consumer Sentiment Survey that came out on Friday, it asks consumers, what are your expectations for inflation over the next 5 to 10 years? That climbed from just under 3% to 3%. Wrong direction. The Fed does not want to see that. So the next report from the University of Michigan is going to be important. This week, today, in fact, this is Monday, later on after this call, we will hear from the New York Federal Reserve on their inflation readings for the 1-year and 5-year expectations. All of this matters now because the market is trying to assess, okay, when is the Fed going to be finished with 50 basis points, right? And move down to 25. Also this week, extremely important data, and I want to go over it. But before I do, in terms of corporate earnings, no doubt about it, it will be Walmart, what they have to say, and the next day it'll be Target, it will be Home Depot. We want to hear what they have to say about us, the consumer. Remember, all of these stores, these big stores, want to get rid of inventory. It's get the consumer in and get rid of all of the inventory. That's going to be what analysts are watching. Also, what they want to see are the consumers not just coming in for necessities, buying food, for example, but are they buying the higher margin items? We know from Dollar General, we know from Home Depot, that consumers with household incomes of $100,000 and more are going in to these stores and they're buying necessities. But what they're hoping for is that these higher wage earners are also going down the aisles with buying higher margin items. We will hear what they have to say when they have their reports this week. It's going to be a very important week to hear about retail spendings. We represent the consumer, 70% of our economy. Have we slowed down our spending? Yeah, we have slowed it down, but by no means has spending cratered. Money in our savings accounts and the banks, money market funds, indicate that there's still money in there, although within the banks and our savings account and checking accounts, that's starting to come down in a more meaningful way. So we need to keep our eye on that. But nonetheless, the U.S. consumer, as long as jobs are still plentiful, as long as we are working, we are spending. This week now, we're going to have I mentioned the Federal Reserve, New York Fed later today, but also on Tuesday, the Producer Price Index. This is important. When we are so focused on inflation, the PPI, the Producer Price Index, takes on a very important role in the picture of inflation. We want to see the input costs for the final product coming down, not going up, but coming down. So this will be important tomorrow, the PPI. Also, we'll hear from the Empire Fed survey, manufacturing survey. It's New York and the surrounding area. It's not as important as what we're going to hear from the Philadelphia Fed manufacturing survey later on this week. But nonetheless, what we want to hear, what we always say, new orders. We want to hear about new orders. We want to hear about your expectations for hiring and what are you seeing in conditions over the next, say, 3 months. We'll hear from them tomorrow, that's Tuesday, and then later on in the week, we will hear from the Philadelphia Manufacturing Survey. That will be on Thursday. We'll also get a picture of retail sales overall, not just from Walmart and from Target. On Wednesday, we'll have industrial production, and we'll also have the National Association of Home Builders. Last week, as those rates started to come down, right, in the bond market, you also saw, and I want to point this out, the 2-year Treasury, which I've always said is the Treasury's focus on where the Treasury market thinks the Fed is going, that yield started to come down. In other words, it rallied. Remember, when the yields come down, it means that there's a rally going on. You know what happened? The home builders across the board last week just shot way up. I'm going to take a look at the end of today where they are, because it was like lighting a match. Holy moly, that builders shot up as maybe, just maybe, mortgage rates will come down in a meaningful way, and maybe folks will come out and buy again. Interesting, because last week there was also a survey on how are home building home sales. What would you go out and buy a house? Oh boy, it was no. This is the worst time ever to go and buy a house. But when those mortgage rates start to come down, it's meaningful. We'll see where the rates are today, because I took a look before this call, and we are seeing the yields inch higher in the 2-year. Again, it is the yield that focuses on what the Treasury market thinks the Fed is going to do. And there's a lot of Fed speak, folks, like nonstop Fed speak. And already Christopher Waller, who tends to be more hawkish, made a comment. He gave a speech over the weekend, and he said, look, we got to continue raising rates. Inflation isn't gone. It's still high. 7.7% is still high. It's not like it's moved that far down. So keep that in mind. Then on Thursday, we'll get building permits, and we will get the Philadelphia Manufacturing Survey, as I mentioned. And the key here this week, it is about housing. On Friday, it's existing home sales, and it is leading economic indicators. But overall, there's so much Fed speak. Remember, there are those who are dovish on the Fed, and they think that the Fed needs to pause, meaning not even raise rates. Just wait, watch to see what happens. Please understand that Powell has emphasized so many times he doesn't want to follow that strategy. He always talks about what happens in the 1970s, when the then head of the Federal Reserve did that. He paused and then raised rates again, paused, raised rates again, leaving the economy in a terrible stagflationary environment. It took a lot. Then Paul Volcker took over and basically just rose rates and put the economy into a recession a couple of times to kill inflation. So this week, the market is assessing whether or not this drawdown in inflation is going to continue, and therefore, are we going to see a shift in the market towards growth from value? It was interesting last week. Money went into technology as it sees rates coming down. It went into consumer discretionary. Also, I noticed, which was very, I thought, important, with the semiconductors just shot way up. And I always say they are a major barometer of global health, of the economy turning. Why? Because the chips are in everything. Speaking of chips, you heard that President Biden meeting with President Xi of China, having a discussion about Taiwan and basically, taking their respective stands on it. But I do want to mention that the Chinese authorities have come out with a number of regulatory announcements targeting COVID, but trying to have it so that they can delineate not just wholesale lockdowns, but for example, if you don't test positive, maybe you can stay at home. You don't have to go into some major lockdown. They're trying to make it so that it is not as damaging for the economy when they have these major lockdowns. COVID is spreading, by the way, in China. There are lockdowns in some of the biggest manufacturing areas where Apple actually has production facilities and works with Foxconn, for example. But they're trying to, again, get away from the wholesale long-term lockdowns and have it more targeted. That's the word that they're using. Also, something which is not new for China, they did, before the plenum, the 20th plenum, Communist Party plenum in October, they did announce that they want more flights coming into China and that they were going to shorten the quarantine number of days for visitors. And that was very helpful, but that actually now is old news. Another thing, and I do want to point this out because of the implications, China also came out with a 16-point rescue, I use that word deliberately, rescue package for their very, very troubled property market. The property market is worth trillions of dollars. That's the development property market, home retail property market, filled with debt, all kinds of debt. COVID restrictions hurt the ability of the property developers to go back and finish properties. They are languishing across the country. And here's the part. Folks buy it, and they own it before it's even finished. And they have to pay mortgages on that. There have been actually, and for China, it's pretty amazing, online, we're not paying, we refuse to pay. And now what's happening is they're coming in with more leniency on the debt that's owned by these property developers. Defaults have been climbing higher. There've been bankruptcies. It's really been, it's been devastating. It's hovering over their economy. And as you know, the Chinese economy is very, very slow. So this has been good news, but I want to point something out about the commodities. If we see that these new measures, it's extending loans, it's allowing regulation for not just new home buyers, but home buyers, to have more lenient conditions to buy. If it leads to a major push in commodity costs, it's going to spill over actually into the global economy. There's no doubt about it. Commodity costs have come down as the dollar has risen. Commodity costs have come down as the fear of global recession hits markets. But again, if China really is moving towards bolstering their economy, by the way, they're the world's second largest economy, you're going to see prices for oil, prices for commodities across the board climbing higher. If these measures are actually going to be introduced and acted upon. So this is important for the global economy. In any case, it's a busy week. Please don't hesitate to call if you have any problems, explaining about the bond market and the 2-year and recession questions. Don't hesitate to give a call. We'll get right back to you and help with the wording of it, because I've done so many client events now. Clients ask these questions over and over again, regardless of where in the country they're sitting. So this, we know, is a common thread of concern about where we are headed over the next 6 months. Thank you so much. Have a good week.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed. guaranteed, not bank or credit union deposits or obligations, and may lose value.